All right, Mr. Craig, how are you today?
I am doing well. Good afternoon, Mr. Whaley. Just giving it a little bit of moment while people continue to join on here.
Very good. Wonder how many people are working from home on this beautiful Wednesday. I'm seeing some frost out there. Kind of frosty Wednesday we got here.
Yeah, the Midwest is getting hit a little bit with an ice storm. Right. Well, it's 2:01, so let's get started. Good afternoon, everybody. We really appreciate you joining McQueen Financial's webinar this afternoon. If you're on the Central or West Coast, it's just becoming afternoon or still morning. So good day to everybody. Brief note, this is going to be about employee benefit pre-funding accounts, the acronym of EBPA. What I'm going to do is talk a little bit briefly about McQueen Financial and then introduce Mr. Whaley, and then we'll get into the meat of the topic. So McQueen Financial Advisors, we provide, we're in a registered RIA, registered investment advisory firm, providing portfolio management and traditional portfolios, as well as CDAs, charitable donation accounts, and employee benefit accounts. We provide asset liability management reporting along with CECL, mortgage servicing rights, and then in the merger valuation and in transaction advisory world, we provide a lot of advice in that world as well. Today, we are lucky to be joined by Zach Whaley as a presenter.
And let's not forget you, Craig.
Oh, all right.
Beautiful
Well,
picture here.
thank you. So I don't know where all the dark hair went, but all right. So my name's Craig Cecilia. I'm the Chief Investment Officer at McQueen Financial and work with clients on different strategic issues. And our other presenter is Zach Whaley, who is a senior investment advisory person. He works with interest rate risk, as well as in portfolio management advice, as well as a team lead, and runs our alternative portfolio team, which encompasses our CDA and EBPA portfolios, and does an absolutely fantastic job with his team as our team lead. So welcome and thank you for participating today, Mr. Whaley.
Thank you, Craig. It's always an honor to be on these webinars with you as well. We're going to have a great time today.
Yeah, good. Love to hear that. So going into administration just on this, I want to point out to everybody on the call, we have at the bottom of your screen, there's a Q&A section as well as a chat. You can use either one to put up a question throughout the meeting. Zach's going to do a lot of the heavy lifting today on presenting information. I'll be monitoring the questions as well as the chats. And so please don't hesitate to call in. After today's meeting, it'll take a few hours, but we'll have the presentation recorded and available, and we'll also put it up on our web link. We record these and put them out on YouTube videos, and we've got a variety of them over the last 5 years out on our YouTube channel. You can subscribe to it as well, and you just kind of Google McQueen Financial Advisors YouTube channel, and you can get to it and subscribe, and so you can see all of our historical webinars and ones going into the future. Anything I missed there, Mr. Whaley?
No, but that YouTube channel is building up quite the library. It's cool to see. I love it.
Yeah, it really is. A lot of great useful tools for both management as well as for boards and board training. So good. All right. Well, let's get into the presentation now here. I'll do the overview and then you can get into some really good stuff. And employee benefits pre-funding is what we're going to be talking about today. We'll kind of define it, why it's there, why people are using it. But also is what opportunities exist with this to make more money, right? The name of the game right now is our margins did have a good year last year, right? We got to worry about non-interest income replacement, and this is just a good way. And how can we make more money? And we'll talk about that. Kind of also, Zach's going to provide a good overview of what we're seeing, what people are doing and how they're doing it, as well as returns. And then also talk about timing, because Zach, is that a big question about timing of anything out there right now?
Timing is huge. And what I hear with timing is, well, what time am I going to get liquidity back?
Yeah.
right?
Yeah, it doesn't matter who you are. It's pretty much the majority of the entire market is working on liquidity. And does that, we'll talk about that. That doesn't not preclude you from considering this and implementing a strategy or adding to a strategy. So we'll talk about that. And then we'll summarize some Q&As that we did not answer throughout that we'll answer at the end as well.
Very good. And Craig, on that note, it's always good to give people something to look forward to. If you're joining the call right now, but you're thinking, man, I'm here for a minute, but in reality, I don't have a lot of liquidity. I don't really know if this is going to benefit me. At the very end, we talk about that. So hopefully you can stick around to the end. If you can't, Craig mentioned go to YouTube, but we talk about liquidity, and we're actually seeing ways to utilize these programs. Even if you literally have no cash, you're borrowing, you're wondering where your next deposit is going to come from. Don't worry, there's still a way to utilize this program. So we're going to get into it. All right, Craig, I thought we'd start out by asking, why are we even talking about this?
I love this. Absolutely. Great opportunities exist, and it doesn't, they don't come to fruition unless we talk about things.
That's right. And one of the things when you think about the acronym of employee benefit pre-funding account, very long name, but the very first word in that acronym is employee. And so let's really start there. We'll talk about what's going on with employees and how does this program benefit. And so, we're all employees, basically. Even if you're the top dog, you're the CEO, CFO of an institution, you're still an employee, and you probably also have employees. And so we are the lifeblood to every company, every organization, to your institution. And so what we wrote here is the very first thing is employees are our greatest asset, but they're also what, Craig? What's our biggest expense?
Our greatest expense, absolutely, that comes along with that. And it kind of makes sense, right? All things that are worthwhile cost money, right? It doesn't matter if you're talking about people or objects, good
Yeah.
things.
I like the way you put that exactly. So employees, we need them, we are them, but we also understand that they come with the biggest expense, and it's not just the wages. Wages are obviously the biggest expense, but when you think about benefits to our employees, the benefits that we enjoy, that's going to be a massive expense for any institution. So we're going to talk about how benefit costs are actually rising. We have a few slides ahead of us, and you're going to see that it's just astronomical. Everybody's talking about inflation. Well, wait till you see the difference between normal inflation, a big basket of goods, and healthcare. It's pretty alarming. And so the question is, how do we handle this? And basically, there are only three ways. Correct me if I'm wrong, Craig, but there's three ways I think about it. We're either going to handle these rising costs by, number one, we can just reduce the benefits that we're offering. That doesn't sound very fun. Number two, we could reduce the employees. Wow. That's an extreme
Might get
possibility.
it might get a little bit of pushback on any of those first two things. Not ideal situations to solve a problem.
Not ideal at all, and we see it in past crises. We'll see that as employees, right? They're one of the first to be let go when we're in a tough situation. So really, none of those are fun. But the third one is, and that's to just increase earnings. And so why do we want to increase earnings? What can we do if we're making more money? What can we do for our employees, especially as it relates to benefits? Well, one of the things that we can do is we can attract and retain good talent. And that unemployment rate, what is that right now? 3.5? It is
Yeah.
low.
Yeah, it's historically low, right?
And we're seeing people move around and have opportunities at different places. And so we know that it's a tough job market. And one of the best ways to keep and retain or even attract, if you're looking for a new position, it's not just the wage, it's not just the environment, it's the total package. So if you can provide your employees a better benefit, better healthcare, better dental, even retirement, if you're able to provide that, your talent retention is going to be so much better than what it could be. Um, and then the next thing we want to really think about is offsetting expenses. There's an old saying that I was thinking about the other day, Craig, that is totally past its time.
You're
And
not
that's
that old now. Come on.
well, I thought about it. A penny saved, a penny earned.
Ah, yeah, right.
A penny is almost useless today. But the message behind that is the same thing, right? If you can save a penny, if you can save an expense, it's literally the same thing as if you're making money. It's not much difference.
Yeah. Since I see is if we're offsetting these expenses, it's going to lead down to more profit for the entity, right? Just offsetting them.
Exactly. Yep. And we're a lot of talk about spread right now with the way interest rates are, and we're seeing people raise their cost of funds. So we know things are getting more expensive out there. And we're going to really get into how you're going to earn more. But suffice it to say for now that these types of vehicles, they can help you earn more, offset your expenses, more profit. And finally, one of the things I always like to go back to is our mission and a margin, right? We have a mission to be the best business we can to serve our community. But in order to do that, to fulfill that mission, we have to be here tomorrow. We have to be successful enough today that we're going to be here generations from now, decades from now, and that all goes down to margin. So everything we talk about today, filter it through this lens. Employees, how can we help them, and how can we be a successful business in order to do that?
I like that last bullet point there that you have on there, Zach, is that mission and margin. And in order to be here tomorrow for our membership and for our community is to make sure we have a financially stable balance sheet and strong earnings to continue us to be there to be able to weather any storm. And so I do like that comment that you have there, and it holds true for everybody on this call.
Yeah, thank you for saying that. What's funny too is that our employees are also our members and our customers, aren't they?
Yeah, they certainly are. And this is a
Yeah,
great way that we're going to talk about today is how do we make it a better experience for them as part of our staff.
absolutely. So before we get into the solution, it's always good to identify the problem, right? Because then why do you need a solution if you haven't fully identified the issue? And really the issue is rising costs. Now, we're seeing rising cost of funds. That's more on the interest environment, right? But then we're also seeing rising cost of literally everything. Even though inflation's coming down, 6%, 6.4, whatever the number happens to be at any given day, things are more expensive than they were before. And nothing is more true than we can see it right here. This graph is pretty alarming.
Wow.
And
Is this your 401k growth? Is that what that is?
which one's mine?
Right. The green one, of course.
Of course. Of course. Yeah. So when we look at this, what we see is, let's look at that blue line first, actually, Craig. So back in 2000, is my mouse showing up, by the way?
Yes, sir.
Okay, awesome. So back in 2000, we can see just the zero mark here where this graph started. We can see all goods and services from a CPI perspective have been getting more expensive. Nobody is disputing that. We can really see the acceleration of that after 2020 hit. All the money hit the economy. We shut things down. Things got more expensive. But what I find fascinating is that when you strip out the medical care, you'd strip out medical expenses, it's growing at a much faster rate than overall inflation. Now, it has recently it's not lifting quite as much as this. And I went down a rabbit hole looking into why, and there's tons of reasons we won't get into. But the most important thing is, as a institution that's trying to provide these benefits, wow, you are really your bottom line is getting more and more expensive as we go through.
Yeah, this is a powerful chart that you have here. And, I'm a simple math kind of person, right? So we can think about it from a conceptual at a very high level is 110% increase over the last 20 years is, and that's a cumulative percent increase. So that's
Mhm.
approximately 5% per year, give or take, rough math,
Mhm.
bear
Mhm.
with me here. And that's just on your Medicare information, right? And so institutions need to grow earnings, 5% per year. And I don't know if everybody's growing their earnings that much just to offset or keep up to par with the just medical inflation that's taking place. It's just powerful to look at this and how the impact to the bottom line, quite frankly.
Absolutely. In fact, we're going to see a little bit later some quotes about that. If you can just maintain, let alone exceed what you've done in the past, you're doing better than a lot of people out there, right? So we gotta beat this expense, or we're going to fall behind. Now, here's another chart that I found fascinating too. Now, um, we may be regulated by government entities, but we're not government entities directly. We're not offering Medicare and Medicaid, right? That's what the government provides for its citizens, but we offer private insurance. And we can see that this graph here is actually showing that overall health services expenses are rising from a PPI standpoint. This is think about the insurance companies that are offering these products. They're getting their inputs are getting more expensive. Things are just, we know about wages getting rising and everything's getting more expensive. So they're going to pass those costs on to us. And what we can see in this chart is it has been affecting the private insurance industry way more than the Medicare and Medicaid. And
Mhm.
part of the reason that I discovered is because they're going to negotiate through politics, right? They're going to use that leverage of, being the government. They can kind of make their own rules, so to speak, where the private insurance companies have to play by those rules, and things are just getting more expensive.
Yep, absolutely. And put this in context. This isn't for 20 years. This is for the last 6 years, call it 6, 7 years. That's interesting. Yeah, just incredible amount of inflation taking place in this private insurance world.
Absolutely. And so that's going to pass on for sure to everyone on this call. It's going to affect you one way or another. And now it's time to talk about the solution, because you're not here to hear about the problem. You're here to hear about the solution. And one of those solutions is the employee benefit pre-funding account. That's why we're here. So let's first talk about who's doing it. Then we're going to talk about what it is, give some examples, be really specific on what we're talking about, and then we'll wrap up. So first, let's look at market adoption. Um, the word is finally getting out there, Craig. I've been seeing this number rise slowly for the last couple of years. Um, I wouldn't be shocked if the next time we do this webinar that it's going to be over 50%. We have 38% of all credit unions that currently have an EBPA. What do you think? What's the under over on that? We're going to get there this year?
It's going to be pretty darn close. It's just the market as conditions are right. As with any type of process that gets adopted in the industry, the word of mouth spreads, the webinars like this to make it more mainstream and understanding the process that others are doing is comforting. And I think it's going to be pretty close to getting to that 50% by year end. I think that's a pretty good estimate, Zach.
Mm-hmm. And it just shows how powerful these tools are because they're growing so much. But I also want to think about this from a competitive advantage, right? We talked about client attraction and retention already. Well, if it's 50%, there's the haves and the have-nots when it comes to this, right? So if
Yeah.
you think about it, which side of the aisle do you want to be on? Do you want to be able to have a program that can provide great benefits, or do you want to be somebody who's still kind of thinking about it, kicking the tires? We're having a lot of people transition from that mindset to actually put into work. So
Mhm.
a lot of credit unions are working with these programs, and they're really for everyone. We have very small credit unions all the way up to billion-dollar institutions, and it scales. The regulation allows you to scale to your size, as we'll see in a moment. But the point is that no matter how big or small you are, this can make sense for you. And so let's define what it is we're talking about here, because we're kind of beating around the bush, right? But what is it we're actually doing? The EBPA is a NCUA created program that allows you to direct a portion of your excess liquidity and hold your laughter. I understand. We understand, don't we? It's not there yet, but it will come back. But it allow you to take excess liquidity and put it into investments that would cover your benefit expenses. So now a little bit of the regulation. It's actually pretty open. I like the regulation is there's some wiggle room there. But here's what you're going to find is that you are allowed to invest up to 25% of your net worth into an EBPA program. And that 25%, it's not a hardline number, is it, Craig?
No, we've seen a variety of institutions across the country have much smaller exposure, but also some that were higher than that, using a variety of products. And it's just a function of, how they're doing it, what products they're utilizing, and making sure they've got controls on the whole procedure and understanding the risk that they have that is putting the credit union at risk.
That's right. In fact, for those of you that are regulation junkies like myself, you want to see things in writing. It's so nice to see it in writing. But the only place you're going to find 25% net worth is in an examiner handbook. It's the only place I saw it. And here's what it says essentially: go up to 25% as a credit union. If you go a little bit above that, we're going to be looking really close to make sure that it's appropriate size for you. But we recommend often, it's no cookie cutter solution, but often funding an account up to that amount if it makes sense, and then taking it from there. So 25% is the number. Think about that, what it would be for you, of course, and what do we do with that that funding, that money? Well, you can put it in newly permissible investments, we like to call it, and essentially you have a standard investment policy. It's got all the list of all the things that you can do, from CDs to maybe corporate bonds or banknotes if you're a federal credit union, whatever it is. But now we're able to go into different types of investments that we may not necessarily have in the standard portfolio. We're going to go into some of those specifically later, but I'll give you an idea. Maybe corporate bonds. If you're a federal credit union, you can't buy anything but a banknote. You can now in an EBPA, you can buy a corporate bond or preferred stock, or even the equity market, which we'll get into later. And why we even thinking about any of these other types of investments, it all comes back to yield. And these yields are significantly stronger than what we're seeing in a standard portfolio. So here is a breakdown, a very high level breakdown, but you can use it with your own math, right? If your net worth was $40 million, and you might be saying mine's 4, that's okay. we'll remove a decimal point. But if you had a $40 million net worth, 25% of that is $10 million. If we earned 8%, then we're earning $800,000 of earnings. And so that is essentially money that you can leverage to pay these expenses.
And that later on, if you go back one for
Sure.
me,
Yeah.
Zach, this is a great example. We don't identify different types of portfolio, but do all portfolios earn 8%?
No. And great question. 8%, you'll see a little bit later. This would more tie to a little bit of capital appreciation in there, with also some income. You're not going to necessarily see that in the most conservative portfolios, but this return might actually be a little bit on the light side with a really aggressive portfolio, depending on market return assumptions that we assume.
Okay, excellent. Then we'll look at a couple of different variety of risks and what kind of expected returns maybe someone might be able to expect.
Yep, exactly.
Okay, gotcha. Thank you, sir.
You bet. And now, what do we do with the earnings? So this is a question we often get. Well, what qualifies as a benefit, right? Is it wages? It's not wages, but it's almost everything else. You look at dental, you look at medical, vision, retirement. There's so many different things. We literally have a line item list of all the different things that we'd be happy to share with you. But essentially, here's what the regulation says. However much money you put in one of these accounts, it's going to earn some amount of return. That return, that income cannot exceed what your expenses are. And you're going to want to monitor this. We actually, if you partner with us, we help you, track this on a yearly basis. But as long as your earnings are not exceeding your expenses, you are absolutely within the spirit of why the NCUA created this program to begin with.
To help that out. I want a little bit of clarification because what you said was a very powerful statement about what do we do with earnings? And one of the things you mentioned was salaries, and not current salaries, of course, but you'd mentioned the word retirement.
Mm,
And it's interesting to see that these portfolios are created for a variety of reasons. Some are truly to cover the medical, the dental, the 457 matching, 401k matching, all these different type of programs that we offer to our employees. But it also, we've seen them where they're really individually set up
hmm
to fund and to offset what future either retirement payout would be to somebody, or to pay to them as when they retire, right? That annualized income that we say, all right, you retired, you'll be able to get this much for so many years. So yeah, these accounts are so flexible. And once again, what you said at the very beginning, Zach, was it's all about trying to really make it a good experience for the employees. We make sure we're taking care of them either now as well as into the future.
Yeah, you're absolutely right. We do. We see this for actually the purpose is to sometimes broadly speaking cover expenses, but you're absolutely right, Craig. Sometimes it's let's zero in on an executive or a couple of executives.
Mhm.
Let's create a goal. When do we want to have money and how much money do we need and how long do we need it? It's actually a pretty simple calculation. We throw in some return assumptions, discuss risk to reward, all that, and then we're off to the races. So if you're thinking about this, and maybe it's totally okay to be selfish in this way, thinking about yourself. If you're an executive and you're thinking, how does this benefit me directly? It could. You could actually use this to fund your own retirement, which is a powerful way to use this tool.
Yeah, great tool instead of like we don't have is the whole pension system. That's kind of a thing of the past. It's you may not remember what a pension is, right? Because you're too young.
I have no idea what that word means, Craig.
Yeah, right. Now you're just teasing.
Oh, you're absolutely right. I think only firefighters and police officers and maybe teachers have pensions anymore, right?
Yeah, certainly.
Yeah. So when we tie this together with expenses, we have a note here that mentally you can look at the earnings to cover expenses is free. Now it's not technically free, right? You have to invest money, but let's look at what we're talking about when we say free. So if you did not have an EBPA, and let's say either now or in the future, you've got a little bit of excess cash. In this example, we use $10 million. All right, so you have $10 million. What are you going to do with it? Well, if it's truly excess and it's not going to loans, you might look to invest it. Fair enough.
Mhm.
So we're just doing round numbers here, but we're calculating a 4% return on a standard investment. Maybe it's a little higher, a little lower. Honestly, depends on what part of the curve, doesn't it? Because
Yeah.
we have an inversion.
Okay, so that 4% is in a standard portfolio that everybody on the call would have,
Yes.
normal investments. Okay, gotcha.
Yep. So if we think about just putting the money there, we got 10 million to do something with. We put it into a standard portfolio. We make 4%. We're going to make $400,000. Very round numbers, easy to follow, hopefully. Now, when we go back to the EBPA, in this type of account, anyways, thinking about an 8% return, it's essentially doubling the return potential. Now, again, it might not exactly look like this. If we go into depending on the risk profile, maybe it's only making 250 basis points more instead of 4%. 2.5% more, instead of 4% more. The point is, though, is that one way or another, you're going to leverage your money. And at the end of the day, if the money is going to go and offset your expenses, let's leverage it to the higher earning. Let's put it in a vehicle that has a chance to earn significantly more money. I shouldn't say has a chance, does because of the fixed income, right? All right, so let's look at this. Will be fun. So Craig, what I wanted to do here was talk a little bit about success stories that we've been hearing.
Okay. So are these stories from existing clients or people, things that you heard in the marketplace, or where are we going with this, Zach?
Yep. These are actual current clients that we're working with. And if you're on the call and you shared this with me, you know who you are. I reached out actually and asked for some quotes. And so we're going to go through three here that I thought were really awesome and kind of tell the story. They maybe give you a perspective of how executives are thinking about this. And so we can see the three different success stories have to do with talent retention, better benefits, and keeping pace with inflation. So let's look at the first one here. Talent retention. This is the quote that we got. So I added those parentheses that you'll see sometimes to give a context here. But because of the EBPA, we were able to provide bonuses for all of our employees equal to or in excess of the previous year. I think that's pretty neat because talking to this person, I got the sense, and actually I pretty much know that they were worried about that, right? You had great years, and then all of a sudden things get a little bit tighter, and then you have expenses continue to grow. Are we going to be able to give bonuses like we did before? And this particular institution was absolutely able to do it, which is fantastic.
That's fabulous. Taking care of everybody. Like you said, it's not just a couple of employees. It was everybody that had a benefit on from what was done here and the actions taken with an employee benefit account. That's really cool.
Hmm. And we can see down here a challenging job market. Of course, it's not fun to go up to somebody and say, "Hey, that bonus, we're not giving you one this year." And we want to keep that going, make people happy in any way that we can. Now let's look at the next one. Better benefits. I thought this was. I don't want to have favorites. I don't want to have favorites.
We all have them, right?
We all have. I thought this was so cool. So this was a relatively new relationship with McQueen that we were working with on this, and they said, "Look, after 1 year of having an EBPA, we just increased everything. We increased our healthcare, our dental, our medical, basically every category." And I thought that was so neat, and it went to show me that you know, some people are feeling like we're maxed out on our benefits. All we can hope to do is offset the expenses. But you might be surprised. There's a lot of people that are thinking, we just don't offer benefits like we want to offer.
Sure. Yeah. That's interesting. I love that. And I like your options there of offering better benefits or a
Mhm.
benefit that you haven't had to offer. If somebody is doing a cost sharing on deduct on did what's the
Like
word
an
I'm looking for?
HSA?
Yeah, like an HSA account
Mhm.
that can offset some of the co-pays. They can increase what they're contributing there on behalf of the employees. Yeah, wow, this is cool.
Yeah, basically that's those are your options, right? You're either in a situation, number one, where you're feeling like you're great, awesome, offset your expenses, penny saved, penny earned, or just offer better like this quote. So I thought that was so neat. And then the next uh, success story here is just keeping pace with inflation. So let's read this. Wage inflation has had a real impact on us. We wondered if we could keep pace with our current health plans and employer matching. The EBPA program helped us continue to match 5.5% and maintain all of our benefits. So thank you for this quote. You know who you are. Appreciate that. And so inflation is real. It's here. Hopefully it's not here forever, at least at these levels. But while it's here, you got to make more money. So here are two options at the bottom. We talked about this at the beginning. You're either going to increase earnings or cut costs, and cutting costs is literally cutting benefits or employees. So that it doesn't feel good to even say it. Now it's going to happen sometimes. We can't avoid it. But if we had our druthers, we're going to increase our earnings.
Yeah. We should maybe just have that one bullet point there just to keep it positive.
I could put a little Eeyore next to the second one. How's that sound?
Tut tut. Looks like rain.
Yeah, exactly. Looks like icy rain. All right, now we're going to get into some specifics. So There are market opportunities aplenty, and nobody has a crystal ball. We like to joke about it, Craig. You and I, wow, we have lots of fun conversations about where the market's going, don't we?
Oh, absolutely. Yeah, we don't time the market, but we've got a lot of opinions about it.
Yep. It's almost funny when you talk about what it's going to do over the short term, because then you have to ask yourself, what's your time horizon?
Yeah.
Are you a day trader? But what's
I wear a shirt and tie, so no day trading here.
Oh, that's right. Yeah. All right. So let's look at what has been going on with the stock market. So we can see over here what happened in 2019 going into 2020. Wow, what a insane drop off. But we've been since recovering. That is until the end of last year. Now, this is the S&P 500. It's my favorite index because it's got a broad swath of companies that are large companies in America. Some people prefer the Dow. Either way, they look pretty darn similar. And so what we can see on this decline right here, those numbers are a little small. I'll read them for you. We had about a 25% decline from the top to this point right here. Now that's good news and bad news, right? It feels bad when it's happening. It's good news when you're buying. So that's really depends on the time frame. But we know just how this was bad news in the past. What happened? We recovered, and we're actually right in the middle of that recovery right now. We can see this green line up to this green line. The market's up 18% from the bottom to this top point. And yes, over the last couple of days, it's trending down, right? We talk about that all the time. But there's opportunities. If you're thinking about, hey, I don't want to time the market, but I want to take advantage of the market, getting in now and just averaging in, you're going to start rooting for the market to go down a little bit to get some bargain prices. If you're already in, you just have to say, well, I'm going to wait for the long term. And, we know what happens typically over the long term. But Craig, what are your thoughts on the market here? Is this a great time to buy? What are your thoughts?
Well, I think I used the term earlier is market timing, and that's one thing that we don't do. Typically, when people are market timers, it's usually doesn't work to your benefit. But we do like a lot of the dollar cost averaging process, and if you look over the long horizon from here, we see that our expectations is that the stock market, if a portfolio is to choose to have that type of risk within the portfolio, is a good time to be going into the markets. There's certain sectors that are still very depressed. The tech sector is a great example. They'll have a recovery. It's going to take some time, but because we got regulatory things happening, and in addition to interest rate cycle that's affected them. But yeah, I do think there's a lot of upside potential over the long period of time.
It's all about time horizon, not market timing. I totally agree with that.
Yeah,
So, and I'm really glad you said something, because a few people watching this or watching it later on YouTube might be thinking, wow, S&P, I don't want to get anywhere near that.
sure.
And
Yeah,
you and and you don't have to. So this is just an example of a type of asset. Don't worry, hold on. We're gonna get there. In fact, let's go there right now. In part, yields are rising massively. And so what we're
mhm,
looking at right now is the 2 and 10-year treasury. So the 2 is it's so easy to get this backwards because we flipped, but the 2 is the white line. And as of the time that this chart was created, it was about 4.7%. And then the 10 years hovering right around 3.9%. This changes daily. But what we're seeing is that yields dropped into 2019 at the same time we had that very volatile spike downward in the stock market. The Fed reacted very quickly, historically quickly, dropped rates. What happened to the 2-year and the treasury and the 10-year? It came down with it. And we basically baseline for a little over a year until the interest rate cycle began to hike. The Fed started to raise rates, and anticipation of raising rates, the yield started to rise. So what does this mean to the EBPA? Well, we are getting anywhere around 250 to 300 basis points of spread over the treasury market when we talk about the fixed income options that we have available in these portfolios. So forget the stock market for a second. You can buy fixed income securities as well. And what an opportunity, I think, right here. Just looking at this historically, it's hard to say when the top is going to be here, but we know historically over the last few, almost 2 decades, going back to 2009 when rates fell, we're at historically high levels right now.
Yeah, we haven't seen these levels in such a long time. And the inversion, the spread between those twos and tens, that spread we haven't seen, right? We're getting close to darn near 100 basis points. I know it's a little less than that, whatnot, but I want to pause for a moment because as we see on the previous chart, and we're seeing here is what a lot of people have been experiencing is in the fixed income world and their standard portfolios, some unrealized losses. And then people that were invested in the stock market, depending on if they had it or not, have seen a decline in value there and marking the market. But I want to just pause and point out that even through this cycle, this volatility that you're showing us in 2022, we still have success stories in these portfolios and how their portfolios are constructed and the securities used. Their still earnings are strong and making a positive impact to their bottom line, even with this volatility. So hats off to you and your team, as well as the people that are entrusting with you in these returns.
I appreciate that, Craig. And one of the success stories that we had on last week's webinar, it's not the EBPA, but the CDA. Wow, we're hearing such amazing things. The earnings that were made, they deeply impacted their community, giving to families directly, giving to YMCA, and the same type of thing. It's just the opportunity to earn and then direct it in the direction that you want to put it is pretty powerful. So let's look at now. That's the market. We can see that there's opportunities there, but what are we actually investing in? So we basically break this down into frame. Let's look at this as a frame of reference, but nothing is cookie cutter. So we do anywhere from conservative approach to aggressive approach and then balanced, so that's in between the two. And so these are the different strategies that we can employ here. So for example, an aggressive portfolio might be 100% in the equity market, maybe in ETFs, common stock, maybe mutual funds, probably not because their fees are so high. But an aggressive portfolio, a good way to think about it is you're exposed to the equity market. Now, conservative, we're going to 100% conservative would completely avoid the stock market, and that would be more of a fixed income strategy where we're buying things like corporate bonds or preferred stocks. We'll see that in a moment. And by the way, another way to think about this that's very important is the difference in accounting treatment. So if you're in a conservative portfolio where everything that you own has a maturity date, no fluctuations, the values, Craig, you just mentioned about fluctuations in value, none of those changes in value actually affect your income. They don't affect your net worth. None of that. It kind of sits over here. It affects a capital number over here, but it's not going to affect your regulatory net worth. So these are the frame of reference. We're going to look at some sample portfolios. Any comments before we get into some more specifics, so Craig?
No, it's very powerful, and I'm excited to see kind of what the kind of a conservative versus a balance the kind of looks like, and what kind of estimated returns could be exist with those.
Right on. Well, let's not wait any longer. Then here's a conservative portfolio. You want to walk us through this one here, Craig?
Oh, sure, yeah, absolutely. As I look, let me put my glasses on here so I can read it, make it a little bit easier for all of us. And
It is a little small numbers here.
absolutely. So on this, we're looking at a client that doesn't want to have that volatility in their financial statements, as Zach just mentioned there. No marking to market on a monthly or quarterly basis, instruments that are not necessarily approved by the NCUA for your standard portfolios, but can go into here would be some higher yielding corporate bonds, where we're modeling at 50% of the portfolio. And then also some preferred stocks. But very, very important to notice in this is they're not perpetual preferred stocks. They have stated maturity dates, and according to accounting and guidelines, they don't need to be marked to market. So, and the estimated returns for the corporate bonds, then these are, and I'll ask you this question,
Mhm.
is the 675 for the corporate bonds, is that the going market rate for account that we would say fund currently, and that's how where we'd be average yield would be being put onto their books at?
Yeah, you got it, Craig. We're seeing much higher yields. We're seeing slightly lower with some options out there around 650. I think 675 is a pretty good conservative estimation right now.
Okay, excellent.
Mhm.
So 50% of this conservative portfolio into that corporate bonds at 675, and then the preferred stocks have an average market yield right now of 7%. So the blended yield is about a 688. After management fees, you're talking about an overall return for a conservative portfolio of a 6%, or 603 to be very precise. I don't want to shortchange you 3 basis points there, Zach.
Hey, that was a non-maturity deposit rate not too long ago, wasn't it?
Yeah, that's a good point. It was a good rate at one point.
Uh,
So that generates on this $10 million portfolio and a $600,000 or 602,500 with, and the institution that was making approximately $4 million in an annualized basis. This is an extra 15% towards the bottom line in income. And once again, this is more of a conservative portfolio, no mark to market. You don't have to worry about the volatility of the market. And these are current market rates.
Excellent. So there you go with the conservative, and then jumping on to the other side of the spectrum here, we have aggressive.
Okay, so we're in kind of stock car racing here. We went from 0 to 100 miles an hour here with the aggressive
That's right,
portfolio.
100%, 100 miles an hour. You got it.
Absolutely. And before I go down the kind of explanation of the returns here, and is it a little bit too early to talk about how one decides, or is that's kind of later when we talk about risk, talking about risk? We're just talking about
Yeah.
returns right now.
Yeah,
Okay.
we'll get to it real soon though after this actually, yeah.
Okay, so going to 100 miles an hour, you look at that whole amount of the portfolio being invested into common stocks. And this could be, and we use the term common stocks, but it could be also ETFs
Right.
or something of that nature that is a basket of goods, diversified risk. It could be actually individual companies. Is that right, Zach?
Absolutely. There's advantages for both. ETFs, broad exposure to the market. You can even
Mhm.
have, exposure to a specific part of the market. Obviously, we would be helping with that, of course. But also, the advantage of common stocks is you can focus on a company that's really strong with maybe in a strong sector and also pays a very good dividend. And by the way, this dividend that we're assuming here is accurate to the yields that we're actually buying. I love this. I don't mind bragging about it at all because I feel real proud of my team and everybody that works on these. Is the broader S&P makes about 1.9% on an average dividend. We're far exceeding that. We actually get 3.3. We rounded it down here to 3%.
I
So great
absolutely.
advantages with those, Craig.
Yeah, I absolutely love that. And they're a good example of with an individual stock, it increases your risk beta and whatnot. But, you can kind of look and chook based on their financials and their strength
Mhm,
and their
mhm.
historical earnings and trends, pick out some. And good example, once again, is the tech sector, how that's getting beat up. There's going to be some, people that come through that. But so average dividend yield of about 3%. And then the return potential is 6%. And this is the return potential is generated on a lot of analytics that we do and what the market and street is expecting for returns on these types of things on an annualized basis for a net return of about 9%. So that's the gross yield on an aggressive portfolio on expectations. The fees net out to about an 815 return on this 10 million, which generates approximately 900,000. And for that same institution making $4 million, it increases earnings by about 22%.
Absolutely. So if you're wondering earlier, how do we come up with eight? That's how we backed into it, right? Just a round number. And for the balanced, Craig, just for the sake of time, I'll just speak briefly on this one, if you don't mind.
Sure, go right ahead.
So this is just the Goldilocks. This is the in between, not too hot, not too cold. So if that was 100 miles per hour, what is this? 71, 75, so you don't get pulled over?
Yes, well done.
Well done. For me, it's really 85. I think you might be higher, but so you can see here we have a mix between corporates, preferreds, and commons. Blended yield about 6.65. And then now we're going to talk about risk, and I'm excited to share something at the end here. So really, we already mentioned this, but now we'll see it in writing. When we go into a conservative portfolio, if we had various rate scenarios and stock market scenarios, like a bear market, where this line right here, if you just focus on this one, that's a minus 20% stock market movement. It's a 300 basis point shock of interest rates. And what happens to the portfolio? It's going to go down in value. But what's going to happen to our net worth? Nothing is going to happen to the net worth, because this does not run through your income statement to net worth, because everything in a conservative portfolio is available for sale, maybe HTM, but we're not marking it to market.
Excellent. And that's kind of a great scenario on that bear market at 20%. Seems very reasonable with thinking about where the stock market is relative where it was right now. An additional 20% shock onto that, correct?
Absolutely. We could go
Yeah.
down to that low that we saw a little bit further. It's not without reason. So we should be thinking about it.
Right. Good.
Absolutely.
Great
And
analysis there.
yeah, thank you. And then in here we look at the balance. So the balance is going to introduce a little bit of fair value, right? So we're going to have 50% of this portfolio would be exposed to the stock market or other assets that don't have maturity dates. So we can see if the portfolio devalues, it will have a slight impact to your net worth. And everybody's different. We run these for you individually. We don't want to just say, well, the sample says this. Let's look at your net worth. Let's look at your current income, and let's definitely not get into anything where we have to say, wow, this might keep me up at night if the markets don't behave. Let's make it so that we can sleep no matter what's going on. And it really comes down to what your current position is and the different risk scenarios that we run. And here's an example we break down. We have the different types of asset classes from the riskless, at least from a devaluation standpoint. Cash is riskless, credit perspective. Of course, it's not riskless from an inflation perspective, but we have cash going to corporate bonds as a type of asset, preferred stock, and common. And we can run different scenarios here, and we can see how the devaluation would affect any given type of asset.
Mhm.
And I really like, oh, I'm sorry, Craig, were you going to say something on that one?
Nope, nope, just agreeing. I think it's well laid out to show that risk.
Yeah, and this next page I think is great, because we'll break it down. What percentage of the portfolio is in fair value versus non-fair value? Well, in a balanced portfolio, 50%. So we look at the fair value. We can say, based on these different scenarios, whether the market pulls back, bear market, or goes into a dramatic custom scenario, even worse than that, what would be the impact, the actual potential dollar devaluation? And that's a number that's really important to do. So we'd be really remiss if we just focused on the reward side. We need to understand the risk and the reward to choose the appropriate strategy for you.
Yeah, good part of the whole due diligence, and it runs up to the board on determining that risk and the appetite for it, and who is comfortable with what. It's ultimately customized, which is perfect for everybody on this call to understand what the risk is and be comfortable with it.
Absolutely. And board education is a key. Absolutely. So now let's wrap up a final few thoughts here before we say goodbye for the afternoon or morning to you. And let's look at next steps and what are potential obstacles, quite frankly. And I love this slide because we hear this all the time, and it's not bad to say these things. We just need to know that there are sometimes solutions to the biggest perceived obstacles that we have. And so probably number one that I hear about is liquidity. I don't have the money, loans are doing awesome, or maybe we just don't have the deposits, and we don't want to go borrow at 5%, even if we can earn, 7 or 8%, there's no spread. Totally get it. So we wouldn't recommend anybody stress their liquidity position to fund an employee benefit account. However, there are very creative things that we can do, and we're doing them actively right now. We can do a swap analysis. On the next page, we're going to give you an example on that, but it's essentially taking your current investments, understanding that they would probably be sold at some type of loss because interest rates moved up. We all know that, but we can increase earnings to such a dramatic extent that we can overcome those losses very fast, to the point where we get a quick break even period, relatively speaking, depending on the assets. And there you go. You're funded by moving one asset to a different type of asset. A lot of potential with that one. We also hear market timing. Now's not a good time. Well, we already covered that one, I think, pretty well, right? It's not time to pretend like we're day traders. We're here. We're going to have an institution for a long time. Let's have a long-term strategy as well. And we can also average in and avoid the market completely if we wanted to. I love this next one, my time. I don't have time. Um, that's probably true. You probably don't have time. But what we want to do as much as possible across all the different things that different services we provide is we want to do the heavy lifting for you, right? So sometimes I hear, I would do it, but I need to think about policy, all that stuff. Let us do the heavy lifting. We can help you and take that off your plate. And then next year, well, this is a funny thing to say in February, but we were hearing this last year. We'll do it next year. Well, it's going to be, November again this year, and people are going to be talking about next year. What we have in front of us is another 3/4 of earnings. Let's not throw that away. A lot of money can be made. So let's talk about it now. Anything else on this page, Craig?
Oh, you covered it really well.
All right. So let's briefly look at this. A swap analysis. We looked at this is a real life example for a client that we looked at. They had some agencies. They weren't earning very great yield there. They were earning 2%, you can see here. And we said, what if we funded an EBPA or CDA based on their risk assessment? We're thinking right around 6.75. We played with a few different numbers based on the strategy. But here's the result. Based on these calculations, yes, we're taking a loss on sale. Totally get that. But we're increasing income on a monthly basis so dramatically that the break-even period is less than a year on investments that are 3.5 years long. You're breaking even so quickly, and you're going to begin to add to the bottom line. $367,000 to be precise. So this made a lot of sense for them, and we're going to be moving forward with this, which is really exciting.
Yeah, that kind of seems to be in line with an estimated balanced portfolio, conservative/balanced portfolio, if I'm not mistaken. Is that correct?
You got it. Exactly. Somewhere in the mix of that, you can really get close to those yields, even if we only bought all corporate bonds at 675. There's your 675 yield assumption right there.
Yeah. Okay. Excellent.
Yeah,
Thank you, sir.
absolutely. All right. So what are next steps? Well, it's not hard, but we need to start here. The first step is being on this webinar or sharing this webinar, maybe with an executive that couldn't make it or your board even. Get people that are going to make this decision, get them educated. We need to understand the program. And then number two, we recommend notify your regulators. It's a courtesy, though. I've always asked, do we have to? No, you don't have to. It's a nice thing to do. I'd rather tell them now, have them say, hey, did you think about this? Did you think about policy? Did you think about risk and educating your board? And you can say yes, yes, yes. And that way, when they come around to see in person, it's all good to go.
Yeah.
You wanted to.
We recommend that you treat it as if it is required, as you want to try to, be inclusive there. It's no surprises that way.
Yep, exactly. Let them know. It's good for everybody. And then we want to discuss your goals. What are you trying to accomplish? Executive retiring, broad decrease of expenses or offsetting of expenses, or maybe you want to start a new program. Okay, how much is that going to cost? What do we need to make? What's our time horizon? Then we want to go into risk. What's your net worth? Should we be in any fair value? Should we avoid it? We're going to give you recommendations. We're not expecting you to come to the table knowing exactly what risk you should be in, but you're going to have an opinion, of course, and we're going to talk through that. And then we're going to determine the size of the portfolio that makes sense for you. You don't have to go all the way up to the regulatory limit, by the way. You can start slow and even fund it as maturities roll off. We're doing a couple of those right now where we have a portfolio set up and no money's in it yet, and we're going to fund it as the standard portfolio investments roll off. That's another really cool way to fund these things. Develop a policy will obviously help you there. Get the policy approved and then open the account and begin investing.
All right, Zach, before we go on, we're coming up on the witching hour here, and there's a question that I wanted to put out there
Mm.
before we kind of get off the webinar here. And one of them is liquidity, or experience liquidity, but how liquid are these portfolios? What happens if we need liquidity out of this or need some of the principal investment? What happens in that case?
Great question. And I love this in the context of, COLI products that I heard about last year where people were wanting to get money out of a COLI product and they were being told, if you take money out, you're never coming back. And I said, I don't believe that. And I fact checked it. Turned out it was true. Don't worry, you're not going to have that problem here. The assets are totally liquid. They're either going to have a QSIP or they're going to be exchange traded. We can trade things very easily in these accounts. So while they are typically longer term investments, buy and hold type of situation, not a primary source of liquidity. All that being said, all those asterisks, they are very liquid investments that we're purchasing here. Great question.
Yeah, you're welcome. I don't know if it's actually after 3 o'clock. There was another one of why they shouldn't do an EBPA. So take that for it. If you want to field that before I just give a closing remark.
Yeah, I would say the reason why you shouldn't do an EBPA is because you can't, and usually you can't because you don't have liquidity, right? And so if you don't have the liquidity, let's talk about why you don't have liquidity and develop a strategy. It's a holistic approach. We didn't even mention ALM once in this call, I don't think, but guess what? It all ties together. Let's develop a liquidity strategy for you. Maybe your loans aren't priced appropriately. Maybe we need to talk about funding. Maybe we just need to do a swap analysis. So yes, there are reasons not to, but we can avoid those reasons.
Yep, gotcha. All right, I got one more. I'll field this one, and then Zach, you can turn the page to the last page there for the webinar. But the last question is the limits that we're talking about. You mentioned the 25%, and then there is a separate, actually written limit for charitable donation accounts of 5%. Those limits are separate, so you can look at the charitable donation account can go up to a 5% limit. Your EBPA is a separate 25% guidance on that as well. So that's a good question as well.
Great question.
I want to just pause here. Zach Whaley, thank you for your expertise. Everything you're doing for clients and your team just are doing a great job. And testimonies from clients is proof in the pudding. For all the attendees, if you turn the page to the last one, thank you. Our next webinar is going to be awesome for not only attendees, but also for board members. Please share it with your rest of your team, maybe somebody young joining the credit union wanting to learn, bring them up to speed on things, as well as existing C-level, as well as board. We have ALM 101 on March 15th. It's an hour long. It's great content, brings it down to the basics. Not overly complex, so it's great to learn. It's ALM 101. Please, if you can join it, let me know. And again, this webinar will be available on our YouTube channel tomorrow. We can also send it to anybody if you want to reach out to your advisor. If you're a prospective client, if you go back one page, we've got some emails on there. You can always use the info or Zach's email, zack@m-f-a.com.
Actually H, Craig, but I won't hold that against you.
That's right. You're in H. All right. Well, thank you, everybody. Thank you, Zach. I hope everybody has a great rest of their afternoon and appreciate you attending today's webinar.
Thank you, everybody. Appreciate your time. Take care.